So thank you again for joining us today. This is a good opportunity mid-year to just have an opportunity to talk with clients and anyone that they might have invited to join the webinar as well. Before we get started, I just wanted to go through some quick disclosures. Most important thing here is just past performance is no guarantee of future results. We're not talking a whole lot today about specific investment performance, but if you have any questions with respect to performance or disclosures, just let us know. First of all, I just want to make sure that everyone has an introduction of the team. So for those of you on the webinar today that aren't familiar with our team, I want to make sure you meet everyone virtually today. Starting on the right, we have our operations team of Rachel and Bryn. The two of them are really critical in making sure that our systems and processes are running smoothly, and they manage all the daily details with our custodian, TD Ameritrade. In addition to that, they handle various client questions and handle most of our cash management transactions. If you're a new client, chances are you would work closely with either Rachel or Bryn in the onboarding process as well. And then on the left-hand side, we have our team of advisors, Joanna, Katie, and myself, and the three of us will be leading this webinar today. And we look forward to sharing our thoughts on some of the most common questions that we've been receiving over the last few months. Now, before we start, let me just say how much I appreciate the work our team has done this year on behalf of all of our clients. In addition to the daily coaching of clients around the questions and uncertainty brought on by COVID, our team executed a substantial amount of portfolio rebalancing and tax loss harvesting back in March and April. On top of all that activity, we've been very blessed this year with our strongest ever first half of new client growth. Uncertainty in the markets has facilitated numerous introductions from clients to their friends, family, and coworkers looking for professional advice or maybe a second opinion on things that they're doing in their own portfolios or financial plans. So for that, we say thank you, and we always appreciate your trust and confidence. And just know that within our team, we have plenty of capacity to handle future growth without diluting the time we spend with our existing clients. So again, before we get started, thank you to both our team as well as our clients for their continued trust and confidence. So as I mentioned, today we wanted to spend some time with you discussing the most common questions we've been hearing from all of you over the last several months. 2020 has no question been unprecedented in so many ways, and this has raised several questions and frankly, a lot of fears. So thank you for taking the time to join us today as we share our thoughts with you on the following 5 questions. The first we'll walk through is what can investors be doing in response to the volatility in the market? We'll also talk about how the stock market, how can the stock market keep going up when everything around us feels like it's getting worse? Then we'll talk about the recovery. It's certainly been a record fast recovery. It's certainly one for the record books, and we'll be talking about why that's happened. And then similar to question 2, we're going to answer this question that we've been hearing a lot, and that is with the S&P 500 just hitting a new all-time high, how is everything recovered so quickly when it feels so bad? And then finally, the one that's might be on top of everyone's mind right now with both of the parties having held their events in the last week is what effect will the election have on the market coming up this fall and leading into next year? So with that in mind, I'm going to ask Katie to start us off. Katie, why don't you walk us through the question of what can we be doing in response to all the volatility in the market?
Great. Thanks, Mike. And hello to everybody on the call today. So what can we be doing in response to the volatility of the market? In times of extreme volatility, most people feel they need to want to do something. They want to do something to take control and to produce some type of outcome. This is one reason some experts believe that investors tend to sell their equities and go to bonds as equity markets plummet. We, of course, strongly advise against that course of action, but there are things you can be doing when markets are volatile, and we're happy to report most of our clients chose to do that back in March. It's rebalance. Let's take a look at the data. So what you're looking at now is a graph demonstrating performance of the funds you own from January 1st until the bottom of the market, March 23rd. The red line represents your bond holding. You can see from the beginning of the year until March 23rd, bonds stayed relatively flat. However, all of the bright colors represent your equities, and the yellow is your real estate holding. You can see the downturn was swift and dramatic, resulting in your equities and your real estate holdings being down between 30 and 40%. Now, it's easy to talk to this when we're pointing it out on a graph, but when you're actually living it, it's a completely different story. Headlines were frightening and no one knew when the bottom might come. Still, we did know one thing. Historically speaking, anytime equities had been down more than 30% in the past, for long-term investors, it's always been a good time to buy. So we called upon you to rebalance and to sell the one thing that was actually providing any type of stability in your portfolio, and to buy equities that had just fallen so fast, we experienced the fastest recession in history. We knew the market would come back, but we never imagined how quickly it would. We rebalance portfolios here. So let's fast forward. Look where we're at today. You can see this is from March 23rd to August 24th, 2020. Most of you rebalanced within just a few business days of the bottom. It's fair to say here that we got a bit lucky. If you look at the red line, you can see those bonds you sold have done well, but they're up just 9% from March 23rd. 9% is menial considering what equities did. The blue line here is your US large cap holding. It's up 48.8%. The purple line is your international holding. It's up 44.5%. The pink line is your emerging market holding, up 42.46%. And again, even real estate, your yellow line here, is up 36.39%. So to sum it up, congratulations to those of you that were disciplined and long-term minded investors, willing to buy without trying to time the bottom of the market. You were able to take advantage of the fastest bull market in history, and equities are now up some 40%. Rebalancing in combination with tax loss harvesting are a few things we can do and control when markets are volatile. And we'll continue to watch closely for these opportunities for you. Mike, are there any questions?
Yeah, a couple of questions here, Katie. So first of all, there was a question on will we make the slides available later? Yes, certainly the slides will be made available, and we'll also record this so that you'll have a chance to replay it or send it on to a friend. There was another question on, are the slides annualized? And the numbers that you're looking at are not annualized numbers. Those are actual year-to-date or period-to-date numbers, not annualized numbers. The third question, Katie, is one that came through. Did all of our clients rebalance?
Yes, so all of our clients actually did rebalance, or not all, I should say, but most, 95% of our clients actually rebalanced when we gave them the advice to do so. But I guess, Mike, maybe that's not the only thing that we should be talking about. That's a great percentage, but really too, what's important is not a single one of our clients panicked and got out of the market completely and went to cash. So that we're really proud of too.
Great. So just a reminder, you can ask questions in the chat bar at the bottom. Love to have your questions throughout this. So as they come through, we'll answer them. So please fire away.
So Mike, I'm going to shoot this next question over to you. How can the stock market be going up when everything around us feels like it's getting worse?
Yeah, great question. And first, let me start by saying that, it's a very normal response for investors to feel like the market should reflect today's economy or today's unemployment environment. If the economy is feeling good and positive, we like the market. We like to think that the market should reflect that. And then similarly, if the economy and unemployment are negative, we're surprised if the market doesn't reflect this same pessimism. So this is exactly why, as individuals, we're not wired to be good investors. Capital markets are forward-looking, and many have called them the great predictors of the future. We're going to walk through the market response to both the financial crisis in 2009, as well as the market response to COVID here in 2020, to give you a better understanding of how markets work and how they process information. So first of all, this is a graph showing you the performance of the aggregate U.S. equity market for calendar year 2009. And as you can see on the left, the market bottomed on March 9th of 2009. And at that point in time, in March of 2009, initial jobless claims had just hit their peak. Okay, so jobless claims are the weekly numbers that come through that tell us how many people have filed for unemployment. Okay, and they hit their peak in March of 2009. And at that point, the market had bottomed down 50% off of its high in 2007. If we fast forward out to October of 2009, so if we go 6 months out to the fall, we had finally hit the point in October when unemployment had peaked. So we're really at that point in the recession where pessimism has hit its peak with peak levels of unemployment. And we had just finished an entire year of negative GDP growth, 4 straight quarters of a declining economy. And in October of 2009, we finally got our first news that we had finally had our first quarter of positive GDP growth in the third quarter of 2009. And at that time, the market had recovered 60% off of its bottom. So if we fast forward to 2020, we see really the very same picture playing out. Again, it starts in March. So again, this is graphing the aggregate US equity market for you. And you'll see in March, the market bottomed. As Katie mentioned, it was on March 23rd, and the US equity market was down about 35% from its peak earlier in February. And it wasn't until 3 days after the market bottomed on March 26th that we actually got our first negative jobless claims numbers. And on the date that we got our first negative jobless claims numbers, the market closed up 6%, and it finished the largest 3-day rally we'd seen since 1933. You go forward 1 month to April, and we have record unemployment in the United States. We had jobless claims that exceeded 30 million people had lost their jobs. We had the largest consumer spending decline in the history of our country. And at the same time, the market finished its best 2-week rally since the Great Depression. When we fast forward out to the fall, we're pretty highly confident that just as in October of 2009, we're going to get a positive GDP growth number in October of 2020. And at that point, right now, markets have recovered anywhere between sort of 50 and maybe 55%, depending on which market you're looking at. And the simple points here that we want you to take away is markets turn down long before the economy or unemployment become negative, right? Markets are forecasting that negative unemployment and negative economic numbers. The second is markets tend to bottom near the point of peak pessimism. I remember no one who stood up on March 3rd, 2009 or March 23rd of 2020 and said, this is the bottom. And for those of you who are watching CNBC or Bloomberg TV, I think you would agree that there was certainly no one, not only on either of those days, but in around any of those time periods that was on TV saying, this is the bottom, you need to be a buyer. The reason for this dislocation is markets have priced in substantial amounts of recovery long before you feel better. If you're waiting for things to feel better, you've likely missed a substantial portion of the rebound. And again, this is exactly why as individuals, we're not wired to be good investors, is the market is looking forward and we're focused on today. Any questions? Katie, there's a question here about rebalancing again. Should we be rebalancing again in our portfolios?
Yeah, so that's a great question. And I would just say that we have been talking about that as a team and looking at it really closely and looking at individual portfolios closely as well. We can say that we do make this decision on an individual basis, but we are getting close to maybe wanting to rebalance in the opposite direction here pretty quick. But we'll continue to look at the market, look at each individual portfolio, and if we do that, it will depend on the next few weeks and months and what equity markets do.
Great. So let's tackle the third question that was on our list today. And that's the question, Katie, of haven't we recovered really fast?
Yeah. So haven't we recovered really fast? Well, the short answer is yes. Yes, we've recovered very fast. It's been, in fact, the fastest bull market in history, but we also experienced the fastest recession too. So let's take a look at just how fast. How many days do you think it took the S&P 500 to drop 35%? 24 trading days. In just 24 trading days, the S&P 500 dropped 35%. So how many days do you think it took the S&P 500 to gain 38%? 70 trading days. Again, the fastest bear and the fastest bull market in history. So to put this number or these numbers in perspective, we wanted to pull up this graph that you may remember seeing. We talked to this graph and showed it earlier this year in our February webinar. And although at the time we didn't know what was about to happen, the data is actually interesting to revisit. This graph is showing the impact on stocks with the past epidemics that we've had. Past epidemics like Ebola, H1N1, and Zika are all listed here. In the blue blocks, you can see the average 1 month, 3 month, and 6 month returns from each of the epidemics. Now, I'm not trying to compare the coronavirus to anything on this page. We're in the midst of a pandemic, not an epidemic. But we thought it might be interesting to see how the market has responded to the coronavirus and how it compares to these past epidemics. Here, you can see the same world index and its performance year to date. You can see that massive correction and then the steep rally. Up at the top of the graph, you can see the comparison of returns using that same 1 month, 3 month, and 6 month metrics that were used in the last graph. If we use February 1st, 2020 as our start date, you can see the world index was down 6% after 1 month, down 15% after 3 months, and down just 1% after 6 months. So again, this time has not been like the rest. The decline was deeper and the recovery has been a slower road to positive, but still, it's not all that different either. Even this pandemic has had a relatively short-term effect on the world equity markets. So the big question on everybody's mind is why? Why did equities come back so quickly? So there are multiple factors at play here, but we want to quickly discuss one of the strongest undeniable factors that we've experienced here in the US. And it's the policy response to the current crisis. It's been unprecedented in its speed and magnitude. So before I walk you through this data, a few quick notes. Remember, QE stands for quantitative easing. QE is a monetary policy where the central bank buys government bonds to help stimulate the economy. Also, in this graph here, we're comparing the coronavirus crisis to two past crises of like magnitude, the global financial crisis and the Great Depression. You see how the linkages occurring through the crisis are the same that occurred in past, but at a totally different speed. While this may be intuitively obvious, we thought these visuals were still worth sharing as they bring life to just how vital the policy response has been in driving the financial recovery of 2020. So what took 3 years, 7 months in the Great Depression took 1 year, 6 months in 2008, and only 1 month in the current crisis. In the Great Depression, it took 3 years, 7 months from Black Thursday before President Roosevelt broke the peg to gold, allowing the Fed to print enough to stop the free fall in equities and the economy. In the global financial crisis, the turn came when the start of QE in March 2009, a year and a half after stocks began to fall. And it wasn't until a pause in QE2 that equities had another sell-off of more than 20%. And then this year, in March, the stimulus from the Fed and fiscal authorities were so swift and so massive that the equity down market lasted only a month, and 5 months later, some stocks were again hitting all-time highs. So what is absolutely critical for investors to focus on today is the cause-effect sequence, which is happening so much faster than it has in the past. And further, the biggest cause-effect drivers are the degree and speed of the policy response and its effectiveness. With the speed of this downturn and market recovery, we've learned it's harder than ever to try and time the market. There are no days to sit and think about strategy moving forward. Another takeaway here, our country is still learning. Remember, capitalism is still a very young form of government. Times like these don't come around very often. We have a limited number of trials to test against. We might only see a decline of this significance once every 10 to 15 years or more. Here you see a young country continuing to adapt, learn from the past, and test the system. The benefits we've already seen in this extremely fast recovery. The unintended consequences are yet to be known or understood. So questions on this section. Do we have anything that you want to go over, Mike?
Yeah, we just had a question, not necessarily related to this section, but it did relate to kind of portfolio management, and the question was around rebalancing, and are clients aware when we rebalance their portfolio? And the simple answer to that is yes, absolutely. We manage all of our assets non-discretionary, which means that we do not have full discretion to act in the portfolios whenever we'd like. So yes, we have a discussion with every client. If they need rebalancing, we have a conversation with them and gain their approval before moving forward. Okay, with that, let's talk about the S&P 500. This is a question that, boy, as we've been meeting with folks, especially over the last couple of weeks, we've been getting a lot. And that's the question of, with the S&P 500 having just hit a new high, whether that be yesterday or last week, how has everything recovered so quickly when the economy feels so bad? And I think first what we need to do is we need to start with a an understanding of what is the difference between the market and an index. So for most people, they get their information, whether it's over their phone or they're looking on the internet, or they turn on the nightly news and they hear that, oh, the S&P 500 index or the Dow has hit a new high. And they correlate that to the entirety of the market. And that's where we do have a little bit of a breakdown. So one thing we really want you to walk away with today is an understanding of the difference between an index and the market in its entirety. And we're going to use the S&P 500 index today as an example. And what you're looking at here are the results, the performance of the S&P 500 index through July, so it's not completely updated. And we're breaking it down by the size of company. Okay. If you look at the top, row, the top 10 companies, their average market capitalization was $850 billion. And they were trading on average at about 31.5 times earnings. And through July, their performance year to date, they were up on average about 10%. And those top 10 companies are all companies you know well. Those are Apple, of course, and Microsoft and Amazon and Google, right? It is predominantly driven by the very large tech companies. If you go down to the second line and we look at the top 50 companies, you can see on the far right that their year-to-date returns were 2.5%, but they were positive. And then as you go down to the other 450 companies in the S&P 500 index, you see that they all had negative returns. And if you look at the smallest 150 of those 500 companies at the bottom there in the last 3 rows, you see that they had substantially negative returns. So the reason we point this out to you is because when you peel the onion back on an index, whether it's the Dow, whether it's the S&P 500, or maybe you're looking at the NASDAQ 100, what you need to understand is that any index is market cap weighted. Now, what do we mean by that? Market cap weighted, in simplest terms, think of it as a weighted average, okay? So market cap weighted means that every dollar that goes into the index is divvied up on a market cap weighted basis. So as you can see, these top 10 largest companies, on average, their market capitalization is $850 billion. If you look at the smallest 100 companies, their market capitalization is less than 10 billion apiece. So when you run the math on this and you look at it, really the smallest 100 companies in the S&P 500 index, their weighting in the index is only a few percentage points, okay? So think of it this way. If I created an index that just had 2 companies, okay, you might think of that as if you invested in that index, half of your money would go into one company and the other half would go into the other company. But that's not the way it works. If one of the companies has a $5 billion market cap and the other company has a $95 billion market cap, then for every dollar you invest in the index, 95 cents is going to go to the one company and only a nickel is going to go to the other company. So the challenge is when people say, geez, everything is recovered, we look at it and we say, well, no, everything really hasn't recovered. What's happened is the index has been driven by just a couple of handful of very large tech companies who happen to be in the industry that has benefited the most from COVID. So to just take that to the next level, we thought we'd go out and just look at a few different companies in a few different industries to make this point even differently. If we start at the top there, boy, there's a company we know has certainly suffered, in a big way over the last 8 to 9 months, and that's Carnival Cruise Line, right? They have not recovered. Their stock price as of this week is still down 70% from its highs in February. If we go down 2 more and we look at Marriott, right? We know those hotels aren't very full right now. Their stock is still down 34%. And then if we look at a few different industries, whether it be oil and gas, we're looking at an ETF that's just tracking the oil and gas sector, right? That ETF is still down 38% so far this year. Aerospace companies, right? We know Boeing hasn't done well. We look at that aerospace sector, it's still down 24% year to date. And it's not until you get down to the very bottom in technology, in looking at a technology sector ETF that's up 28% this year, that you really start to see that no, everything hasn't rebounded. What's rebounded is the index. And that's the big difference here. When we think of the market, we think of all of the companies in the market. And we think that the market has actually priced different companies in different industries in a very rational way, given the risk that they face. The challenge when you look at an index is that an index, because it's market cap weighted, is really not representative of the market. So again, when you take a look at these indexes, just make sure that you really understand what you're looking at and understand that you're not looking at the market. You're looking at really 5 to 10 really large technology companies that have become very powerful in driving the returns of those indexes. So one data point I'll give you, if you take the 5 largest companies in the S&P 500 index, the ones I just mentioned, Apple, Amazon, Microsoft, Google, those 5 companies' aggregate market capitalization today is larger than the total market capitalization of the Japanese market. Katie, do we have any questions?
We do actually. We have quite a few. I'll start by this one. So we had one person ask, how are the funds I own different than the funds different than the index?
Yeah, that's a great question. And if we look at it, it all does have to do with that weighting. So as you may remember, right, you do own low cost, passively managed funds, but they're not index funds. So if we go back and we look at this chart, effectively the difference between what you own in an index is it's a little bit in the details. So you're just like the S&P 500 index, your largest holdings are going to be Apple and Microsoft and Amazon and Google. But you're not going to have the same weighting in those companies as say the S&P 500 index is. So you're going to be underweight some of these really large companies at the top of this chart here, which by the way are also quite expensive on a valuation basis. And you're going to be overweight some of the companies towards the bottom that are trading at much lower valuations and are much less expensive on a valuation basis. So you're going to own a lot more companies. Our clients own about 3,000 US companies as opposed to the S&P 500 index, which is just 500. So you're going to have more diversification and you're going to have less weighting in those big tech companies, and you're going to have a little more weighting in smaller, more value-oriented companies. Any other questions here?
Yeah, I think.
Yeah, so
answered that one right there.
Yeah, I think we've answered that. So yes, again, our clients are going to own all 500 companies that are in the S&P 500 index, okay? But they're also going to own 2,500 other companies that are mid-cap and small-cap companies. And so they're going to have to own those 500 companies that are in the index at a little smaller weighting so that they can own those other 2,500 companies. I'll give you just an example, though, of one company that our clients own that, believe it or not, has become a value company because its stock price has been beat up a bit this year in compared to the tech companies, and that's Berkshire Hathaway, okay, which is founded and run by Warren Buffett, right? Believe it or not, Berkshire Hathaway now has become sort of a deep value company. So we're gonna have a little less ownership in Apple, and we're gonna have a little more ownership in much lower priced stocks like Berkshire Hathaway.
Yeah, that's good. Just a reminder, if we don't get to your question in this webinar, we will be following up with you privately. So we'll just send you another email message, but we want to make sure to stay on track today. So we'll kind of keep going. And if there's time at the end, we'll come back to questions as well.
Great, Joe. Why don't you tackle this this last question regarding the presidential election and how it could affect portfolios?
Yep. Thanks, Mike. So I get to cover this fun topic of the big presidential election that's coming up. So we wanted to share some historical data of past elections and presidential terms so you can keep your emotions in check and not panic no matter the outcome in November when it comes to your portfolio. So we all like to think there's a direct connection between the idea of this is who is going to be president and this is what's going to happen to the markets. But it's not quite that simple. Let's look at this graph that shows the annualized S&P 500 returns during past presidential terms. Here you see each term, presidential term, and the red and blue represents the party, not necessarily a positive or negative return. So the big question I pose here is, can you identify some pattern? And we would say no. There's so many things that influence the stock market. Yes, the president has an impact, but so do other things. Other presidents, prime ministers around the globe, what companies are doing, global pandemics, technological advances, oil shortages. These are so many things and other things that have an influence other than just one president. So it's hard to draw that conclusion that this president or this party that is now in power, and therefore this is what the markets are going to do. As a long-term investor, you must bear uncertainty. You may not like the president that gets elected, but that shouldn't determine your outlook of your portfolio. The goal is to capture long-term returns of the market over time, regardless of who is president. So let's look at this different graph. It shows the growth of $1 in the S&P 500 going back to 1926. Again, you see the red and blue represent the president's party. So I'll give you a couple seconds just to take a quick look at this. So you see during each presidential term, you can see market volatility. Markets are up, markets are down. In no one presidential term do you see a consistent market movement in one direction. Each time period or each presidential term shows a range of volatility. So in the coming months, you will be exposed to an overwhelming amount of news, articles, predictions that may make you nervous, but it's important to make a disconnection of what a campaign promises and what actually happens when that candidate is in office. For example, let's look back at President Trump's campaign 4 years ago. He promised a lot, and when he got in office, the Republicans had control of the House and Senate his first couple of years in. The biggest accomplishment was tax reform of the many actions he promised. Same goes for President Obama when he campaigned 12 years ago, and he too had a long list of promises. The Democrats had control of the House and Senate during his first couple of years in office, and the biggest accomplishment was healthcare reform, not much else. So the bottom line, politicians say and promise many things, and they just don't get a lot done when it comes to them being in office. As long-term investors, it pays to stay the course during these volatile times, and especially now with this upcoming election, and not let emotions dictate decisions to your portfolio. Katie, do we have any questions?
Let's take a look really quick.
Yeah, Joanna, it looks like we do have a question here regarding Biden's tax policies. What's the most likely impact if Joe Biden were to be elected on my portfolio?
That's a good question. So let's go back, and when looking at proposals made by any candidate, I would ask the question, what is the likelihood that a proposal such as Biden's tax changes would get passed by the House and the Senate? So it goes back to my previous comment about what happened during the Obama administration and the Trump administration. And assuming these proposed tax changes do go through, it just reverts to the tax laws during President Obama's term. If we go back to the first slide, during his term, markets were up 15% during his time. So not a bad time, even if we're to revert to those tax changes that Biden's proposing.
Great. Thanks, Joanna.
So I would ask, so what's next? And we would say, let's focus on the things that we can control. So first, we will continue to monitor portfolios for rebalancing and tax loss harvesting opportunities, just as we did back in March. In times of volatility, it's important to review your plan, your financial plan, and look at the big picture rather than focusing on the short term. Interest rates are at a historical low, so we encourage you to review your current mortgage rate and reach out if you have any questions about refinancing. This would be a great time to refinance. On that same page, because interest rates are low, there are not a lot of good options to park cash for short-term needs. We would be happy to explore other options for short-term safe investments for your short-term cash needs. We will also continue to reach out for IRA to Roth IRA conversions towards the end of the year and work with your accountant and determine if a Roth conversion is appropriate for your tax situation. And lastly, just wanted to share a quick reminder of new legislation that passed earlier in the year. So with the Secures Act that passed back in December and was in effect January, the required minimum distribution age was pushed to age 72 if you were not 70 years of age by January 1st. And then with the CARES Act, all RMDs, required minimum distributions, have been suspended for the year. Therefore, we will not be making these distributions out of your IRA account unless you have specifically requested. And then for future, qualified distributions from your IRA are back in action for 2021. And any amount that you do for unqualified charitable distributions can be used against your RMD amount. So if this applies to you, expect to hear from us in January. As always, please reach out if you have any questions regarding any of these topics.
Thanks, Joanna. So we're just going through a few of the questions here. Now's a great time. If you have a question that you haven't had a chance to ask, please type it in. We've had some excellent questions come through. Several that I'm going to kind of wrap into one here. We've had, probably a handful of different questions from different people about the size of the quantitative easing and the potential impacts on both interest rates and inflation with the level of quantitative easing that's happened. So certainly don't have any slides prepared for that today, but let me just give you a framework maybe in a way to think about that. If we go back to the quantitative easing that Katie talked about earlier in 2008, 2009, there were two very, very commonly held beliefs. And I wouldn't say commonly held, they were really unanimously held beliefs. And that was that the quantitative easing that brought us out of the financial crisis would for sure and unquestionably create rising interest rates and inflation. And most people would even suggest that it would have created hyperinflation. If we fast forward, 11 to 12 years later, and we look at what we've actually seen, we've seen neither of those, right? Interest rates today are substantially lower than they were in 2008, 2009, and even before COVID. Okay, before COVID happened, interest rates were still lower 10 years later than they were in 08, 09. And on the flip side of that coin, over the last decade, we had the lowest inflation over the last decade that we've had in any decade in anyone's life that's on this webinar today. So I would just say, kind of similar to Joanna in her comment of, hey, make sure you think about what can actually get passed when you look at a lot of these presidential election promises. The same thing is true on this quantitative easing. Some of the long held beliefs of what this will create certainly have not played out at all in the most recent periods. So I wouldn't necessarily just believe that things that happened in the 30s and 40s are going to happen now. We can certainly have a much deeper conversation on that one-on-one, but I did want to just give you a couple of data points to address that one. It looks like that's it for questions for today. So before we jump off, I did just want to once again, I wanted to thank our team. We've really enjoyed the conversations that we've had with all of you throughout this year. Obviously, we're not happy with the reason that we've had to have all those or many of those conversations with related to COVID, but we have enjoyed those conversations. We know that today may generate a lot of questions or thoughts in your mind about your portfolio or about your financial plan, and we would just encourage you to reach out to your advisor on the team, whether it be today or sometime next week or even next month as you're thinking through these things. We're happy to talk to you and walk through any questions you've got with you. And then finally, I just wanted to remind you, we are going to have a recorded version of this that'll be available. We'll post it to our website, and we'll also send out a link to it. So if you're really bored this weekend and you want to kill an hour, you could always listen to it again, or maybe more likely, if you've got some friends or family members that you think would benefit from this information, please feel free to forward on to them. Other than that, thank you again for joining us today, and we look forward to talking to you in the future.